people think taxes are complicated. And so they're sort of afraid to ask questions because you don't want to look stupid. But the reality is that the best way to save on taxes is with planning.
Hey, everybody, you have just joined the #1 real estate podcast in the world. We are legends in our own mind. We are the 0 to 100 podcast. And I have Mitchell England with me today. And our third co-host, Gabriel Hamill, is late. And like Gabe always says, because he's just like this hardcore wrestling coach and all the things. What is it? If you're on time, you're late. If you're late, it's unacceptable. So Gabe, this is I'm joking.
When I have technical issues, he also says that that's because I have limiting beliefs. So, and I don't know how those two are tied, but let's just say that.
No. Okay. So yeah, Gabe has limiting beliefs. Apparently his entire computer setup crashed right before we joined. I think that's an excuse. I think if you know Gabe, he's probably laying around eating ho-hos and getting fat. So anyway. We also have, so what is the 0 to 100 podcast? As a reminder, it's all about cash flow real estate. It's all about scaling a real estate portfolio to generate enough passive income to replace your day job. And I think probably one of the many benefits to real estate, this might be like top 3, maybe even top 2, is the tax benefits that you get with real estate. And I'm excited to introduce our guest today, Amanda Hahn. And I was going to say our partner, Matt McFarland's going to join. He may or may not join along with Gabe. We're fluid. We're just going to roll with it. But so Amanda and Matt are CPAs and tax strategists who specialize in helping people use real estate to save massive amounts in taxes and keep their hard-earned money. As founders of Keystone CPA, they help educate investors on how to maximize tax write-offs, legal entity strategies, tax-efficient ways to access profit, how to use 401k money for real estate, and much more. They are the authors of the highly rated book, Tax Strategies for the Savvy Real Estate Investor. That would not include Mitch. He's not savvy. And they have been featured in prominent publications, including Forbes, Finance Council, Money Magazine. They talk at Google, CNBC, Smart Money, Talk Radio, as well as the bigger podcast. I'm sorry, what is this? The Bigger Pockets? I've never heard of them. The Bigger Pockets podcast. Yeah. Okay. Don't know who they are. Either way, today, Amanda and Matt have helped thousands of investors nationwide to save on taxes with proactive tax planning. Amanda, thank you so much for joining the 0 to 100 podcast. Welcome.
Yeah, thanks, guys. Super excited to be here.
Hey, what's happening? And that's a wrap. We've just dropped nuggets of gold. Everybody loved the show. This might be one of the best episodes.
It was incredible.
Amanda, thanks for joining us. Oh, hey, Gabe.
The feedback has been incredible.
There is no way the show has done anything good yet. Amanda, sorry you had to hang out with these two guys.
Yeah. Well, hey, we just got through the intro, so you're just on time. So
yeah, we did.
Right on time.
Gabe is fashionably late. I was talking about the on time, you're late. Late is unacceptable. Tech issues are limiting beliefs.
That's my line. Those are my lines.
I know.
That is your line. So I had to use it against you while you weren't here. So
we just did the intro. We were talking about, I think a lot of people, they underestimate the tax benefits of real estate, or they don't really think about it. I think everybody thinks about cash flow and appreciation, but I think the tax benefits are like, I would say top 2 or 3 benefits of real estate. Obviously, real estate can be levered. Here's the deal, man. The government, they want us to provide housing. They want us to provide real estate. The government doesn't accidentally give tax benefits. They give tax benefits to entrepreneurs, so they provide jobs, right? So you get a bunch of W-2 people out there paying half their income in taxes. They want that, right? They want people like us to create businesses and hire people. They want people like us to provide housing for real estate. And so we're excited to have Amanda on the show. We want to dig into Amanda's background, but obviously I've got a lot of burning questions about tax strategy, because here's the thing. Taxes are your #1 expense in life. And the only certainties you have are taxes and death. And so Amanda's here to talk about how we can mitigate at least the tax part. Death part, go see your doctor. So
anyway. Oh my gosh, that's a lot of words, Travis. It just seems like you're just going to
today. I had my coffee. I feel great.
So Amanda, how do we save money? I mean, this is a big question, but how do we save money on tax? I mean, maybe you start with an overview of like, I don't know, your thoughts about like how to use real estate to save money on taxes. And then we can kind of get in the nitty gritty. I know we want to talk about the big, beautiful bill, but I'd love to hear like your perspective on just like what are the things that people can do? How do you help people save money? Maybe just like an overview and then we'll dive in.
Yeah. Well, first off, thank you guys so much for having me. I'm super excited to be here. My first time, I think, on this podcast. And I love being on platforms like this because one of my passions is really in educating people that taxes is not something that just happens to us. I think a lot of Americans feel that way, that tax law favors wealthy people, tax law favors big corporations. But the reality is there's only one set of tax rules and we all play by those same rules. And just like what Travis was saying, the tax law is designed to incentivize certain actions for us to take. One of those is building a business. Another one is providing housing. And real estate sort of does both, right? We provide jobs for people who are helping with our properties, and then we provide housing to our tenants who are guests who are staying in our properties. So I think for everyone, just to understand that tax law is not only favorable to super wealthy people or large corporations. We could utilize those same rules if you were just an everyday investor, or even if you're a full-time W-2 person dabbling in real estate on the side. There's absolutely ways to control your taxes. So we have to change that mind shift that it does. I mean, death sort of happens to us, I guess, but taxes doesn't have to happen.
I'm trying to live forever. I'm trying to live forever, and I've never paid taxes, so I feel like I'm at this point doing pretty good.
God bless Gabe and the fine work he does with not dying and never paying taxes.
Amanda, I'm curious how you got into kind of the CPA world, but also more specifically how you got connected in the real estate investing world. Was this you're just a tax nerd and you were like, man, this is fun and exciting. And I mean, my accountant, he loves this stuff. So, like I get it. But what was your start?
I'm actually the third generation of real estate investors in my family, and I never wanted to invest in real estate. So my grandparents growing up were very hands-on landlords. Like I grew up living in the same condo community that my grandparents owned. And so it's just not something I wanted to do. I wanted to get like an office job. I want to be in corporate America. And my parents really encouraged me to do that. So growing up, I always wanted to be a CPA. I knew I was good with numbers. I kind of, went to school, did the whole thing, got my CPA license, got my first job at one of the big 4 public accounting firms. So that was kind of my dream. I happened to end up in the real estate specialty group in the big 4. And so I worked a lot with real estate developers, people who had companies that invest in multifamily, and of course the individuals behind those companies. And that's sort of how my husband and I came across real estate again as an advisory role and being able to see wow, this is how my clients are making so much more money than what I was doing in corporate America at my big cushy public accounting job. And they were paying, a lot fewer taxes than I was, making more money. So that's sort of the transition of how we personally got into real estate.
I like that you say that. I mean, when you go and you get a job like at the big 4, you're making a lot of money. You're feeling good. You're talking about your annual compensation and the benefits with your friends until you get the pay stub. And then you want to smash your head into a wall. When you realize that the government is fucking robbing you. I mean, in a lot of cases, the government wants billions of little W-2 people running around paying half their income in taxes. So that's interesting. So Amanda, do you own real estate yourself? Do you leverage the asset? I'm sure how could you see your clients saving millions on taxes and not partake?
I mean, the reason we started our firm was because we started investing ourselves. So believe it or not, as CPAs, and when we first realized how much taxes we were paying, we did absolutely nothing about it for years. And that's why I could totally relate to the average person who's not a CPA. And you're like, this is just something that happens to us. I had the same thought, oh, well, my wealthy clients don't have to pay tax because they don't have a W-2 job. They have real estate. So of course I would. That's not me, so I'm just going to pay my taxes. But it was when we first decided to start investing, okay, we knew how to do the tax side of it, but we didn't know how to make offers. We didn't know how to analyze deals. And it's probably shocking for people like your CPAs. You don't know how to do those things. So we started going to local real estate meetups. And that's where we started meeting everyday folks who were they have no idea what tax planning is. They don't really understand that was a thing. And so we started our own firm because we're hey, all the same stuff that our clients do, everyday investors could do the same thing, right? Just fewer zeros behind those numbers. So yeah, we did all the things that our clients do. We started house hacking. We had, our first kind of like rental that we did BRRRRs with, and transitioned into investing in syndications, using 401k money for real estate. So all the stuff that we talk to clients about are things that we've done ourselves or continue to do ourselves.
You mean you didn't have to go to the golf course and smoke a cigar with those big, evil, rich capitalists to find out that inside tax scoop where you can rob the government and just crush the poor? Isn't that funny? I'm joking, but isn't that funny how like taxes are so politicized? Like it's like they're in the center of so many political discussions. And it's funny that I love that you said like everybody follows the same rules. I get so sick of hearing this sort of like, well, this is them and not me. And you're like, no, like, and I love my mom dearly, and I hope she doesn't listen to this particular episode, but gets so angry at her boyfriend because my mom was a school teacher and she got just throttled with taxes. And he was a school teacher too, but he also bought rental properties on the side, right? Kind of, a little slumlordy, but we like him.
I really hope they're not listening to this episode then, Travis.
I know.
Travis is fired up.
But the point I'm making, she would get so mad. She'd be like,
her boyfriend was a slumlord. Yeah.
Right. But she would get so mad because she was like, and Larry had a farm, right? And so he'd depreciate his tractors and, there's all these, I guess, additional tax write-offs for farms. And she would like kind of like be mad at him and mad at the government and mad like, and I'm like, and I learned to pick my battles. I'm like, Mom, you kind of could do the same thing,
Yeah, but the whole thing about like the rich have all these loopholes and they're taking advantage of things that folks can't. I love that you started with that, by the way, because it's really a level playing field. But the thing is people don't want to put in the work to even understand, like even just the tip of the iceberg on tax benefits. And I think what I sort of like, I'm not a tax expert, but like I understand the basics. And once I understood the basics, then I could go, okay, I'm going to get a hold of somebody like Amanda, who's really going to understand this and really help me optimize this. That was the key for me, was like, okay, I know about bonus depreciation. Do I know exactly how to put it together? No, not at all. But I know the terminology of a cost seg and understand, I know what that means, and bonus depreciation and the overall sort of like directional effect of that. And then I go get somebody like you and I'm like, oh my gosh, this is so impactful. So I'm curious, do you think, or do you see most real estate investors just like have no idea of what's going on and therefore that's why they're not taking advantage? Or what's the mindset challenge?
Yeah, I think you hit it on the nail, right? There's two things. There's one is people think taxes are complicated. And so they're sort of afraid to ask questions because you don't want to look stupid, right? But the reality is that the best way to save on taxes is with planning, right? Planning ahead, making sure we're doing the right things, we're buying the properties, we're making the right investments, we're documenting the right way so we can legitimately save on taxes come next April. But I think a lot of people are fearful. They don't want to meet with their CPA because, well, one, a lot of people can't reach their CPA, right? I email, I call, they don't call me back. If you could find them, I think a lot of people are fearful of like, wow, I don't know much about it. Like, what is bonus depreciation? I don't understand it. But the reality of it is tax planning is simply open communication with your CPA. If you have a good tax advisor, what we want to do in our planning calls is actually us asking you a lot of questions. Like, Mitchell, what are you doing this year? What are we doing with this property? Are you going to refi? How are we getting the other partners in or out? Right? Where's all of our cash? Where's all of our equity? And it's in those questions where we can come up with different strategies. Whereas I think a lot of people tend to think the opposite. It's like, oh, I heard about bonus depreciation on YouTube. I'm going to call my CPA, explain that to them, and they're going to tell me whether I can do it or not. So that's an example of a bad relationship, right?
Or a bad CPA, you should not be when you have to educate your CPA and they have to go out and figure it out. Like, go find another CPA, right?
Yeah.
And I love, by the way, you invest in real estate because, like, I should ask my CPA, do you own real estate? There's a good chance he doesn't. I mean, besides your primary.
Amanda, I had a question. I know it's kind of a broad question. But, we have listeners that are maybe haven't bought their first rental. Some are fairly seasoned, hundreds of units, maybe thousands of units. So I'm just curious. I mean, I know it's not as simple of a question, but what would you say overall some of the top strategies to avoid taxes for real estate investors specifically?
For real estate investors, I mean, obviously depreciation, right? One of the benefits of owning rental real estate is that we get to depreciate or write off the purchase price of the building over time. So that's sort of the baseline, right? All real estate investors get to do that. What I love about it is you guys mentioned leverage. So depreciation is kind of that beautiful point where we can use leverage, right? The bank's money to then create depreciation year after year, because depreciation is based on purchase price, regardless of how much down payment I'm making. So the more comfortable an investor is with leverage, the more depreciation you're potentially getting. And that's just a paper write-off, right? We're not actually losing money. The property is probably going up in value. And around even that concept of depreciation, there's so many additional layers to that. We can accelerate it. We can slow it down. We can optimize it however makes sense for me as a specific taxpayer. And that strategy might differ for Amanda versus Gabriel versus Mitchell.
Let me repeat that, by the way. Someone could buy $1 million apartment building. I mean, they can put 5% down on that apartment building, but they get the benefits of the entire $1 million. And the bank is the one financing the bulk of the purchase price. Let that sit in. Like, you use the two most powerful things in real estate, leverage and the tax benefits. Because you could take that $1 million, let's say, and 750,000 of that maybe is the building, right? The sticks and bricks on that. And then, like Amanda saying, and I'm not a CPA, listen to Amanda, not me, I'm a dumbass. But all I'm saying though is you can take that $750,000 and you can bonus a lot of that off of your income. Maybe you want to accelerate it because you have a big capital gains event, or you have another tax event that you want to write off, or you can slow it down over so many years. But it's the whole $750,000 of the structure, and you put down $50,000 on that building. That's crazy.
Or no money down, right? Even for someone who's doing no money down real estate, it's the same thing, because for depreciation tax write-off, we're looking specifically at the purchase price of a property. But yeah, so then, with that, obviously another thing that a lot of real estate investors, especially newer investors, don't understand is when you hear about the tax benefits of being a business owner, most of those tax benefits, write-offs, also apply to real estate investors, because we're in the business of investing in real estate. And that's just like it sounds. You're in the business of owning rental properties. I don't mean you have to have an LLC or a corporation, right? That's what a lot of people are confused on. Like, I just bought my first rental, or I didn't buy my rental yet, but I have these expenses that I can't write off because I don't have an LLC. And that's not true at all, right? Are you in the business of owning rental real estate? If so, you are able to take most of the same tax write-offs that business owners are able to take as well. So those are kind of the two major components of owning rental real estate. And then we get into, can I use real estate tax benefits to offset different types of income beyond just my real estate income?
Oh, I remember having to explain this to like an early lender, because, the majority of my early portfolio 20 years ago was all bought no money down seller financing. And these were interest only loans. So between depreciation and interest, I always had a paper loss. And I remember going to the bank years later and they were like, well, you're not making any money. I'm like, no, these are all cash flow positive. Take out, I'm having to explain this to the lender. Take out the depreciation, take out the interest. Those are the biggest line items, but those are just paper losses. And that straight line depreciation took me a long ways until I got to a point of scale that I actually needed to have a little more strategy with my tax planning.
Yeah. And that's also an important planning part too, because we work with so many investors, right? Is there's an optimal place to be where I'm saving the most amount of tax, but I also look good from a borrowing perspective. And so, yes, the ability to we call add back, right? Add back depreciation to your income, because it's not a true cash flow expense. And, certain other things as well that are maybe more discretionary. Like, I funded a retirement account. That's not a fixed cost. I might not have to fund it next year. So sometimes in tax planning, we often work with the client's lender too, to figure out what meets both of our goals, save tax and also look good on paper for borrowing purposes.
I like working with commercial lenders because they get it when you're like, oh, well, you took all these losses. And you're like, yeah, we get it. We understand you're a real estate investor. We work with the real estate investors. When you talk to a lot of these sort of like residential underwriters, you just want to smash your head into a wall. They're like, well, you've lost a lot of money. And you're like really? How do you not understand this game?
Amanda, I've got a question, and maybe the answer is no, but like, do you have an example or even just like a hypothetical situation you could talk through. Like I talk to a lot of folks who say are making a lot of money in their W-2, and like if they were to take advantage of, say, bonus depreciation, cost segregation, and possibly become a real estate professional, like what would that mean? Do you have any clients where you're like, look, they were making this much, paying this much in taxes, they became a real estate professional, they cost seg the bonus depreciation, and we're saving this much? I just want like for the listeners to like put this in numbers potentially. Could you run through a scenario like that?
Yeah. I mean, we have so many, but I'll give you sort of a very powerful example. So if you have a married couple, right? Somebody who maybe one spouse makes $400,000, the other spouse makes $60,000, both working full time. As something you referenced, right? If we're both working full time, it's difficult to be a real estate professional for either one of us because one of the requirements is I have to have more time in real estate than my job. And so one of the analysis that we go through with a client profile like that is to figure out, does it make sense for one of the spouse to stop working, right? So for someone who's making $60,000, if you stopped working and instead qualified as a real estate professional, and if we bought a property that's, let's say it's a $800,000 property, we do cost segregation, we write off the furniture, if it's a furnished rental, oftentimes the tax savings might be a couple $100,000. But normally you can't use that against W-2 income because you're both working full time. But if that spouse was to stop working, you actually net more in your pocket at the end of the day because you give up $60,000 of W-2 in exchange for $100,000, $200,000 of tax savings.
Well, that's why if you're listening to this, like, we're throwing around bonus depreciation, cost segregation, and these different terms. But in the end, like that's such an impactful, like, you heard what she said. One spouse isn't working anymore. They qualify as a real estate professional. You're saving hundreds of thousands versus working full time for 60,000. Like that is a massive deal.
Yeah. And if you're buying the properties and you get, let's say 30, 40, 50,000 of cash flow, you've effectively replaced that income by itself, right? Because remember when you're working to earn that 60,000, we're paying taxes on that. So maybe I'm netting something a lot less versus I can make half of that money in rental income. If I'm not paying taxes, I come out the same. Plus now I have these other tax savings too.
You can't get appreciation in your job. It just never works out well that way. So that's pretty cool. So we talked about depreciation, and without getting into the details, if you want to know more about that, get a hold of Amanda. But you can bonus depreciate, you can straight line depreciate. There is depreciation recapture though. And I think that's something also a lot of people forget, where they just think I can just get 100% bonus depreciation, especially, over the last few years. And then they go to sell their property. Oh, it's worth X amount of dollars. I'm going to sell it. I'm going to reap the profits, head down to the country club, look like a baller. Bam, depreciation recapture. You have to pay that back if you sell the property. So what is your strategy for investors on recapture? I mean, obviously, we'll hold the property forever, never sell it, or hold the property, refinance, pull your equity out via cash out refinance. But how do you explain that strategy to your investors that want to maximize depreciation benefits, but not get hammered with recapture?
I mean, it's just about proactive planning, right? So if you're a client, you told me, hey, I have a property, I'm going to sell it next year. I'm going to cash out, I'm going to move my money to the stock market. Then very likely I will say, let's not do accelerated depreciation because we're saving taxes today just to pay taxes tomorrow. But if the profile is different, you're saying, hey, I'm going to hold this property for several years. I may sell, cash out and invest in the stock market. We still might do it because depreciation recapture is simply saying, hey, you already depreciated something. So eventually when you sell, we can't claim that to be our cost basis anymore. We're going to pay taxes on what we already deducted. And so, if I could delay my taxes in this scenario for a couple of years, it often still makes sense. But the longer term play, and for me in practice, I rarely have clients who build a portfolio to then decide to sell, cash out, and invest in stocks. Just very rarely does that happen.
What a dumb idea.
So the typical strategies are kind of what you mentioned, right? I'm going to hold it forever. I'm going to cash out, refi, use my cash and continue to build. I'm going to leave it to the next generation where I get step up basis so that nobody pays taxes in my lifetime, but also 1031 exchange. Maybe I'm outgrowing my single families. I want a 1031 exchange into a mobile home park or a multifamily or self-storage. if I'm doing all the right things in a 1031 exchange, I continue to defer the capital gain so I don't have to deal with recapture. So there's a strategy called swap till you drop. I don't know if you've heard of that before. So the concept is swap 1031. Yeah, but you haven't dropped yet, right? So the dropping part is until death. So we keep 1031ing until we pass away, and then it gets to the next generation. Nobody pays recapture taxes.
And this is why when you go talk to most multi-millionaires, they have a large real estate portfolio, or they're selling, but they're rolling.
They can't get rid of it.
Right. They just accumulate and then they pass it on to their kids, I guess.
To me, it sounds like 1031s are dangerous because they kill you. Is that what you're trying to say? No, I'm just
So speaking of 1031, do you see that ever going away? I always like it when the politicians threaten. I think Biden was threatening that quite a bit. We're going to get rid of the 1031, or whoever was behind Biden.
He forgot about it.
Right. Yeah. But all the lawmakers on the right and the left side of the aisle, they all own real estate.
They all take advantage of the 1031 exchange, all of them.
Right. That's never going away.
Yeah, it's really interesting. I think every election in the past, how many ever years, this is always something that comes up. It's always being discussed. They want to they want to put a max on it per year or a number of times you could 1031. And then nothing really ever changes, probably like you guys said, because, politicians also own real estate.
They just rattle off the same shit.
It just sounds good.
Election, and then they just go back to doing what they're going to do to self.
It sounds good because it sounds like it's getting rid of a loophole, right, for wealthy, bad landlords. But the reality is that it's necessary, right, to continue to have people build wealth and provide housing. Otherwise, a lot of people just won't sell. I think a couple of years ago when there was talks in an election about 1031 exchange going away, a lot of our clients were like, well, I'm going to sell what I have to, and I'm just going to keep everything. I'm not going to trade up because what's the purpose of it?
Well, I think people forget the 1031 benefits because you can take, say you have $300,000 in equity that's generating you X% return. You can take that same equity, sell that property, harvest the equity, roll it into the next property, a bigger property. In fact, you have to buy a bigger property, right? Equal or same size or larger property. And then you can lever up your returns on that. You didn't pay taxes. Now you're getting a higher return on your equity in the next asset. It's a really powerful tool. I love the 1031 exchange, although I haven't done enough as I should, I think.
Amanda, do you ever caution your clients though? I've also done multiple 1031s. I think it's a great tax code, but I've also watched people buy horrible investments because they're more focused on saving taxes versus actually buying a good investment. I've met many investors where they're like, I got to buy something this week. I got to close something this week. And they make a bad investment decision just because of the tax benefit.
There's actually research somewhere that showed, don't quote me on the number, there's research somewhere that showed people who are involved in 1031 exchanges pay on average, I think a couple percentage more in purchase price than what the fair market value is. So yeah, absolutely. That is something that we have to take into consideration. First of all, not everybody needs to do a 1031 exchange. If you're, we have clients who just have a lot of passive losses. Let's say they're husband and wife doctors. They just never were able to use those losses in the past. Well, guess what? When you sell your property, you get to use all those old losses to offset the gain. Even if you're not a real estate professional, we can now use those losses to offset W-2 income as well. So not everyone should do. Sometimes in that scenario, if they did a 1031 exchange, it's actually detrimental because they keep trapping that loss. But one thing I always tell clients too is, again, just planning, right? You think you're going to sell this property, then let's start looking for replacement properties before we sell. A year or two ago, when it was such a hot seller's market, it was difficult to find the right replacement. So we kind of work in the reverse. Let's find the replacement first. When we list the one to sell, we know it's going to sell quickly. So we're less concerned with that. So now we're not so stressed out on the timing of everything.
So is it true that, as I understand, like say I'm going to 1031 a property and I blast through my timeline. I don't find a replacement because I'm like looking for a good deal. And now I'm like, oh shoot, okay, I got to pay my taxes. Now, if I just bought another property in that year and bonus depreciated that property, obviously it depends on the size and all of that, but those losses would act against my gains from the past property, potentially protecting me fully from paying taxes. Am I right about that?
Yes. Yep. So that's what we call a lazy 1031 exchange. So a sort of like a rescue. And so we have clients who are like maybe people who are older, who've owned multifamily for many, many years, right? And maybe they don't want a 1031 exchange because they don't want a bigger property. They just kind of want to be more passive. Normally, you can't sell an apartment and 1031 into like a syndication, right? So that's not a match. So this is where that lazy methodology comes up really well too. So I sell my apartment, I have a gain, but in the same tax year, I invest in another rental or in a syndication. If those are kicking off tax benefits, generally I can offset one with the other.
So if you go back in time a little bit, you talked about building portfolio, never paying taxes, 1031, exchanging right, and then leaving it for the next generation. And you said step up in basis, and you kept moving quick. And I want to go back to that because I don't fully understand that. And so what does that mean? When we hand it to our children, are we stepping up in a basis there so there's no taxes? But what does that mean?
So I'll give you an example. Let's say I buy a property for $100,000, right? And then now it's worth $500,000. I 1031 exchange into another property that I buy for $700,000. I hold it my entire lifetime. And by the time I pass away, now that property that I bought for $100,000, now it's worth $10 million. Okay. When I pass away, if it's in my name, my LLC, or my trust, my living trust, then the kids will inherit that property. And when they inherit the property, I'm using kids, but it could be anyone, right? Your beneficiaries, they inherit the property. When they inherit the property, they get it at fair market value. So when it exchanges to their hands, now their cost basis is $10 million, if that's what it's worth on my date of death. So then eventually when they sell, the first $10 million, they don't have to pay taxes on, because now that's what we call step up, right? I went from 100,000 to 10 million in my very extreme example.
So that property never experiences taxes on its gains in that scenario.
On the gain, right? So we say it's tax-free gain in your lifetime.
But they could also continue to exchange, right, to the next generation.
Mm-hmm. Yeah. They could if they wanted to. Sure, they can continue to do that. What's really interesting too, what I see a lot with clients is, especially as people age or their kids age, they start to do wacky things where they start adding their kids to title. And you guys might have parents who are like, oh, because my mom did that. She's like, I'm older, and what if I'm incapacitated? I'm going to add you to title, because my mom also owns rental real estate. And so she's like, I'll add you to title. And it's really important not to do that, because once you start adding your kids to title, well, now guess what? Maybe your kids are 50-50 owners with you. So now in that example, when you pass away, only half of the property gets step up in basis. The other half that's in your kid's name, well, that's just old basis.
Is there a limit to
really
this?
Important.
Because I know with the Big Beautiful Bill you have, and I want to get into the Big Beautiful Bill, and I actually do want to ask about a reverse 1031. But on the Big Beautiful Bill, I know there was a lot of talk about how much this is different than the death tax, because there was a limit that I think was like 14 million, or maybe it's is there a limit to the amount of step up you can get, or could you step up hundreds of millions of dollars worth of tax basis when you hand off to the next generation?
Yeah, there's no limit to step up. So yes, the step up just means whatever you had, now it's fair market value.
So don't ever sell real estate.
Definition.
Don't ever sell real estate. Just hold.
We just made everyone's kids millions of dollars just now.
Cash out.
Yeah. There is. So yes, the One Big Beautiful Bill basically made permanent the individual lifetime estate tax exemption. So roughly about $15 million per person. If you die, the first $15 million roughly of your estate is free from estate taxes. If you're married, that's $30 million. But let's say your net worth is $50 million. Well, guess what? As a married couple, we can only exempt $30 million. So then the rest will have to pay estate taxes on. And so that's where the planning comes in for our clients whose, net worth is over 15 million per person. Then we're looking at, okay, how do we shift some of those outside of our estate? We don't get the step up, right? But in exchange, we can avoid maybe future estate taxes.
Why do you do that? Why wouldn't you just hold it? What if all of your net worth is held in real estate? And does the estate tax not even really matter, because you can just pass it on to the next generation? They can benefit from the cash flow, and that can be part of their portfolio, and they don't have to worry about hitting that 14 million.
So again, if your estate is under $15 million per person, then there's no reason to do these complicated trusts, because it all gets step up basis. But if your estate is over those amount, then that's where we have to do different planning, because whatever's over that exemption, you have to pay, your estate has to pay taxes on it before it gets to the next generation. So those are the things to, kind of consider depending on where your estate is. But to answer your question, why would you not hold your real estate forever and ever and ever? In real life practical scenario, what if your spouse doesn't do real estate? Right? Do you want to leave them with a portfolio of, a couple hundred doors if they've never touched real estate? Maybe your kids don't want to handle real estate. So a lot of our clients at that age are looking for alternatives. That's where they sell and they get into syndications, because it's like, gosh, do I want to leave my husband or my wife with all the real estate? They've never handled it and I'll be gone.
I mean, I'm going to sell it because I mean, for me, I don't want to, I went to school with a lot of people who inherited a lot of money. And like, for me, it was like a handicap, in my opinion. Everyone has different sort of theories on this or philosophies, but like these kids were like, had millions and millions of dollars, and I'm not sure it really served them. It was like drunk driving and Dodge Vipers and things. It was just a disaster. So I'm like, man, I think I'm going to just sell it and burn it all and we can start over.
I'm not going to sell it all, but I think it's a personal thing. I mean, I like sharing this. I mean, this is something I thought about for a long time. I mean, I actually put off a lot of the strategy of creating a trust and doing all these things because I didn't have clarity, but it's kind of changed through the years. And I still think living as long as possible is going to be the best way to pass it down, because then your kids become adults and you can see how they have functioned in life and became,
that's a good point.
So yeah, Mitch, as long as you start eating better and exercising a little bit, then you don't have to worry about it.
Are you saying I look like a marshmallow? Is that what you're trying to tell me?
Yes, a nice tan marshmallow, like a s'mores marshmallow.
I've been running a lot.
With the haircut, it's more of a potato.
So. Well, if you met Mitch's daughter, Evelyn, Mitch's daughter is at least 10 times more mature than Mitch. So,
Mitch, the one that told Mitch that I would kick Mitch's ass.
She's raised me. Yeah. Gabe and her like became friends, and she's like, "Hey, don't talk back to me, Dad. I'll have Gabe beat you up."
Dude,
I'm like,
hilarious.
I'm sorry.
Yeah, she's got such a high emotional IQ. She's a smart girl. Okay, so let's talk about. I do want to, before we move on past the evil 1031 exchange, I want to know what a reverse 1031 exchange is. Like explain that.
A reverse 1031 exchange is where you buy the replacement property before actually selling the current property. So usually, just like a regular one, you have to work with an intermediary, right? So it's not just DIY by yourself. So the intermediary typically will set up a special purpose LLC so that your replacement property is purchased. It goes into the LLC first. And then, from there, you go and you sell the current property that you own.
Yeah. How do you do that? Because it doesn't have to be an arm's length transaction. And if the replacement property is already owned by you in an LLC that you own, doesn't that violate the rules of a 1031 exchange?
So no, the special purpose LLC is going to be owned by the intermediary. So that's why the intermediary is involved in it. So the real estate will go into that special purpose LLC. You'll close on this property, and then the exchange will close from that perspective.
So you buy it from the intermediary. You buy it from the intermediary, essentially.
Yeah. I mean, the intermediary is kind of representing you, basically, right? Same as the regular 1031 exchange. I'm not buying it from the intermediary. They're holding the asset for me as part of the 1031. We don't see a lot of reverse 1031 exchange in practice. And I think the reason for that is because you can only do that if you have a good amount of cash for equity, right? Because I have to close on the property before I can sell this one. So the movement of the money or the timing of the movement is what typically prevents people from using a true reverse. What a lot of people do is sort of what I described earlier. It's not a real reverse 1031. It's sort of a pseudo one where I am already identifying and trying to make an offer on a replacement, but I haven't actually closed on it yet. I'm going to simultaneously list and sell this one so the timing works out.
So let's talk about the big, beautiful bill. It's big, it's beautiful, and it's a bill. And so I guess, what would you say are some of the most noteworthy items in this bill as it pertains to real estate? Like, what about this bill excites you? What about this bill concerns you? How can we take this bill and leverage it for our own good? Like, talk about this thing for a little bit.
Well, I mean, I think we touched on the big one, right, which is 100% bonus depreciation. So in 2025, prior to the signing of the One Big Beautiful Bill, we were at 40% depreciation. And so the One Big Beautiful Bill brought it back to 100%. So for those of you who are, investors who bought property after January 19th, 2025, if you got a cost segregation estimate previously. The benefit of that probably, more than doubled, right? Because they were using 40%, now it's at 100%. So that's very significant for a lot of our clients who are buying real estate. If we're trying to calculate potential taxes, it's a big shift, right? Whatever you're expecting to pay, probably going to be cut by half effectively. What's really interesting about the 100% bonus depreciation is that it's only available if you purchase and put something in service after January 19th, 2025, which is super crazy. So if you bought something before January 1st to the 19th, then you would still get 40% bonus depreciation instead of 100. Yeah, it's crazy why they made it. Well, January 20th was inauguration date.
Yeah, we know why.
Maybe
we
that's...
know why. Yeah, of course. Yeah. And you could thank me January 20th. So
yeah.
Is that like previous where it drops every year? I think it went from like 100 to 80, or is it just like, how long do we get 100%?
Forever. It's permanent now. So not only is it not going down in percentage like the old version was, it is actually now permanent. Permanent meaning it's not going away. So we can expect to have 100% bonus depreciation in the foreseeable future, unless if somebody changes the law.
So that's interesting though. Do you find that once these things are implemented, it's tough to take away, even if it's a sort of a democratic, say the pendulum swings and we go more to, democratic side, is that, in other words, like what's the likelihood of that going away? Do you feel like it's like, no, now that we got it, that's the precedence, or, is it just hard to say?
I would just say it's much harder for it to go away, right? When in a normal scenario where it just sunsets, by law, it was going away. So that's a certainty. If by law it's not going away, it is always harder. It's always harder for law to be passed. Like we've seen, even with the One Big Beautiful Bill, right? There was so much going on. There was so much negotiations. Now, will they say, okay, I'll get rid of 100% bonus in exchange for something else? I mean, sure, that could happen, but it's just harder.
You have people that are, we have more, not everybody buys real estate. Not everybody wants to leverage the asset. There's a lot of W-2 workers out there. There's people that don't ever do this. And when it's presented to them that this is evil and they're getting one up on you and they're not paying their taxes, they don't care. Why would, that's what I see. It just depends on your voter base.
Well, and bonus depreciation doesn't just apply to real estate investors, right? It applies to small businesses. It applies to large corporations. So, we always talk about it from the perspective of real estate, but it's such a welcomed thing because, small to gigantic companies all really welcome that. It's just the ability to write something off. Like I spend the money, I'm going to write it off instead of waiting 5 years or 7 years, right? So that's basically the gist of what bonus is. But the One Big Beautiful Bill, what's really interesting. It's called One Big Beautiful Bill because it's sort of really all-encompassing. And it's been a while since we've seen a bill that has benefits not just for real estate, not just for businesses, but also just for everyday taxpayers as well. For just homeowners, right? Homeowners, before we can only write off up to $10,000 in primary home property taxes and personal state income tax. That was the cap. But now with the One Big Beautiful Bill, basically 4x'd that write-off. So for homeowners, now we can write off up to $40,000 of our home mortgage interest. And that one, I don't know if that's forever. I don't believe so. I believe that's there's a sunsetting, but don't quote me on that one. All of the different benefits have different start and end times. So I need a little cheat sheet to memorize all of those.
Except for bonus depreciation. By the way, I just looked up 1031. This is interesting. It says that it traces back to the Revenue Act of 1921, and then the current version of the 1031 exchange traces back to 1986 Tax Reform Act, which to me is interesting because, like you said, like the likelihood that the 100% bonus depreciation goes away is probably low. And so I was sort of comparing the two. The 1031 has been around for 100 years from what I can tell. And then obviously a little bit of reform in 1986. But that's pretty exciting if this bonus depreciation stays around forever. This is it changes lives. In my opinion, that's a big deal.
Well, and also too, I don't know if you probably have heard it on the news, right? The two other big new things that came out of the One Big Beautiful Bill is tax-free tip income, right? Up to $25,000 if you earn tip income from your W-2 or even as an Uber driver. $25,000 could be tax-free. If you work overtime, up to $25,000 of that could be tax-free as well. But a lot of those have income limitations, right? Or even the new child tax, the better child tax credit. So with everything in taxes, there's income thresholds where like if you make too much income, now you don't get this benefit. And that makes real estate even more beneficial because if you're someone, let's say you made $500,000 and you normally are not able to get some of these tax perks, but now you invest in real estate with either real estate professional or you're using a short-term rental loophole. Well, now I'm going to bring my $500,000 of income down to $300 or $250. That opens up even more tax savings through tax-free money or other tax credits too.
Because you're lowering your income. You're like literally just going in and saying, yeah, I didn't make 500K. I mean, I did, but I didn't. Wink, right? I made 200K or whatever the case is. Just one last question to you, a personal question I have on the big, beautiful bill. What do you feel? I mean, there's a lot of anger about the one big, beautiful bill. I mean, Elon Musk was he's spoken out against it. The bromance started to break up over this one big, beautiful bill because people feel like it's going to create even more of a deficit in a country that has a deficit that's literally crippling us. And so I want to play devil's advocate. Do you feel like maybe this is for all of you guys. I ask all of you guys, do you think it's going to create an additional deficit that's going to put our country further in debt? Or do you subscribe to the top-down theory where you believe that if you're allowing people that own businesses in real estate, or even like you said, your average taxpayers, your homeowners, your service worker that's collecting tips, if people can keep more of their own hard-earned money, is that going to then go back into the economy, spur the economy, create more W-2 jobs, creating more taxpayers, or whatever the case is? So do you see this deficit actually happening, or do you believe that top-down works, or trickle-down? What do they call trickle-down economics? Do you believe that works?
Trickle-down economics. Yeah, I mean, it's difficult for me to say. That's probably above my pay grade in terms of how that works macroeconomically speaking. I will say, being a CPA to real estate investors, business owners, tax changes like this do impact people in their decision on whether to invest, how to spend their money. So a lot of my clients were waiting to purchase real estate. I mean, partly because of the market and interest rates, but also partly because we weren't sure if bonus was coming back. So incentives like this, at least from an investor's lens, do impact our decision making, right? In terms of, do I make this investment? Do I sit on the cash? Because if I sit on the cash, odds are I'm going to pay taxes, right, on something else, the other income I'm generating. So they do have a pretty significant impact. I do think that one big, beautiful bill, I just talked about how it's pretty encompassing in terms of corporations, investors, everyday homeowners, just gig workers, right, who are earning tips and stuff. But also it does encompass non-tax stuff. And I think that's what a lot of people are unhappy about, right? It's like, we always talk about the tax benefits and the savings for everyone, but what about the other things about, I don't know, immigration and border control and those kinds of stuff? I think that's what a lot of people are upset about.
Mitch, Gabe, what do you think? Do you think that, because this is a huge tax benefit, not just for business owners and the real estate, you keep more of your money, you're going to spend more of your money in the economy, your values are going to go up because that's an expense in real estate that you don't have to think. Do you guys believe in trickle down, or do you believe this is going to crush us?
I think to an extent I believe in trickle down, but I also I take a little more of a holistic approach to I will never let who is in office dictate my level of happiness or my level of success. And that's the same with look, tax laws, whatever, going to change. But my autonomy is very important to me and my freedom is very important to me. And so at the end of the day, I understand the world is always changing. Laws are always changing. Codes are always changing, but I'm not going to personally let that dictate how I live my life, my happiness, my time with my family, my freedom. I think a lot of people, and I'm not saying, because I've had this conversation with a lot of people, I'm not saying that things that, the president, all past presidents do or don't impact people. But I also believe that a lot of people let that emotionally impact them more than it actually impacts them. And now they're all upset and they're hating their day and their week and their life because this person's president or this person's not president or this has changed. So at the end of the day, I'm going to live my life to the fullest, regardless of what changes in the economy or who's in office.
Right. I mean, even when we were at 40% and I was still happy for the most part.
But when there's a tax code change, I mean, I did 8 cost seg studies in 2022 and 1 in 23 because I wanted that 100% bonus appreciation, because I knew that I had some potential capital events coming up, right? So I took advantage of what was there. I'm like, hey, I also refinanced 4 properties in 22 and pulled a bunch of tax-free cash out because that's what was available. Interest rates were low. My properties appraised out. I mean, it's, and so as things change, you be ready to pull the trigger and make moves when those changes come.
Yeah, no, I know that. And I'm just like, personally, I'm just curious, like from a macro standpoint, like, yeah, we're going to play the game. Whatever they're going to lay out the tax law, we're going to play the game. We're going to follow the rules and do what we can to reduce our taxes, maximize our income, grow our wealth, grow our passive income, live life to the fullest. I'm just curious. So, and maybe Mitch, for you, do you feel like this is going to create more of a deficit, or do you think it's going to spur the economy and create less of a deficit, doing the exact opposite of the opponents?
Well, I'll preface with just like Amanda said, this is above my pay grade. So, but my thought is, it's a dynamic issue in my opinion, because personally and professionally, it benefits me in a huge way. And so, the bucket of real estate benefits from the big, beautiful bill is a big deal for me personally. And I do fundamentally believe that we need to, incentivize business owners, real estate owners, people who are creating value in the marketplace. I really do believe we need to incentivize those people because they are out every single day working their asses off to create value for everybody else. Now, the other side of that coin is we have a country that operates at a deficit. I don't love that. What does that mean? They collect revenue, right, from taxes, from everything, and then they spend more and they print the delta. I do not love the fact that every administration that I've seen in my lifetime runs at a deficit and it prints cash and it devalues our dollar. And so for me, it's a dynamic issue. I don't love the fact that we're increasing the deficit. In a perfect world, it would be like incentivize business owners, real estate owners, but find those savings other places so that we can operate a country where the dollar is not consistently depreciating. Now, again, I don't know how this thing plays out. Do we actually create more tax revenue because we're incentivizing business owners and real estate owners? Maybe. It could be a little bit of shopping math too if there's not cuts in other areas. So I'm split. I mean, when I look at the 30,000 foot level, I don't love increasing the deficit. I don't love the fact that we continually increase the money supply. That hurts our W-2s the worst, right? Our school teachers, our fire people, every single year they're getting a demotion. And that causes a lot of angst and a lot of frustration, I think, when you go to the grocery store next year and prices are 2-3 times the last year, or maybe I'm exaggerating, but that's what it felt like over the last couple of years. So I can't take a holistic opinion on the big, beautiful bill. I know personally it really benefits me, but I'd love to see our government, whether it's this administration or the next or whoever, really, really control the deficit and get this thing right-sided so we're not printing cash and destroying the dollar.
I don't think we're ever going to see that. I think wasn't Clinton the last guy that brought us into a balanced budget? And then from then on out, it's just been dive the airplane directly into the ground.
Yeah, it was Clinton and Monica Lewinsky. They really got things right-sided. So, but I think that...
But here's Amanda, bringing this away from Bill Clinton and Monica Lewinsky.
I love those two. I love those two.
Amanda, I'm curious though. It's you work with clients, they want to save on taxes, right? I personally way rather see more money in the people's pockets than the government's pocket. I think business owners, real estate investors, they've done well and they will do better having that money and reinvesting that than I would trust the government to do with their money. I mean, I'm assuming with your clients, Amanda, they want to save taxes because they want to go deploy that capital into more investments, right? They're going to stimulate the marketplace.
Yeah, it's really funny. I just made a post on social media a couple of days ago about, it was making fun of how real estate investors don't have any money. Everybody is cash poor, but equity rich. And I got so many of the shares on it. I'm I really kind of hit, that's how real estate investors are, right? We save money in taxes and we're already pre-spending it on the next property or reinvesting it into the improvements or whatever it is. And I think that's what the government, intended when they set out the law. But I will say years ago when the C Corp tax rates were lowered, the concept was, okay, big corporations are going to save money and then they're going to go out and hire more people and make investments. But what they did instead was they bought back their stocks from shareholders. So now the company is more wealthy. That sort of also makes sense too, right? If you're a business owner, because I have cash, I'm not going to go out and hire more people. I'm going to hire more people if I have more demand for my services, right? So I think this works well in real estate, like we're all saying, because that's how the real estate works, right? We're deploying our money, but it could also kind of go off the tracks if we're talking about another use case like large corporations just buying back their own stock.
Well, the last thing that I'll say about taxes is I think I disagree with Gabe. I think we need to give more of our money to the government because they know best and they know better than us. I mean, here's a great example. Look at Portland, Oregon. They spent $1 billion of taxpayers' dollars to clean up homelessness, and go look at it. It looks fantastic today.
I'm surprised you can say that with a straight face, Travis.
Yeah, no, they know best. We don't let Big Daddy government take care of the things because they know how to spend our money for sure. Yeah, I love that. So.
Well, I'm just amazed that we made tax fun, I think. Okay. And so Amanda, you're a big part of that because I think that taxes, can be a boring topic and people can be intimidated by it. But honestly, the way that you speak to taxes, it's understandable, it's palatable. Like, I think people are going to get a lot out of this episode. And so, yeah, I appreciate all your knowledge.
I mean, I have, most of my clients, when they come to me, they'll say like, I hate taxes. I'm really bad at it. It's almost like a shameful, like, oh, you see me, on podcasts or on stage, but I'm really, really bad at taxes. And then I feel like for a lot of them, after we do planning, after working together, they love talking about taxes. I have a lot of clients who are always talking about taxes on social media, YouTube, and I'm always like watching it, like making sure they're saying the right things.
I actually enjoy it. Like I enjoy talking to my accountant because like I think I mentioned at the beginning, he's just kind of a tax nerd. He loves to just like nerd out on tax law. He can answer all my questions. I mean, like I was on the phone with him the other day for an hour. Like he's excited about it and excites me. And I'm like, hey, here's what I'm doing. Like, let's strategize around this. Here's what I'm planning to do. If I sell this this year, like it can actually be fun. And most of the tax code is written on how to not pay taxes. And a lot of people fail to realize that, or even ask questions around that, or build enough wealth to even worry about that for that matter.
Yeah. I mean, the government does tell you like, this is how you can pay less taxes. And people like, oh, and then people follow it and they're like, they're bad. They get villainized. Oh, they're rich. One last thing, and I'll just advise our listeners to go out and check out if you like development, which we're long-term buy and hold cash flow guys. If you like to develop real estate, I was just having a conversation with a friend of ours because we're in our hometown. We're looking at this like vacant lot, but it's in a good area. Opportunity zones. And we do not have enough time on this call to really dive into O zones, but I know that was getting sunset in 2026 or a lot of those benefits. I think the big beautiful bill extended a lot of that. If you have capital gains, you're selling a company, you're liquidating a bunch of stocks and you have a big cap gains event, or opportunity zones, if done right, and there's a lot of nuances, but if done right, you can save a lot of money on taxes. It's not only on the initial capital gains, you can reduce your taxable income on that, but you can also make a lot of money on the subsequent investments because you get step-up basis and you get to exit, after 10 years and basically not pay capital gains on the secondary investment. So I'd encourage you, if you have a large capital gains event, you have the ability to do development, go check it out for sure. And there's specialists that really understand O zones. I certainly don't. So I'm not going to pretend like I'm any smarter than I am.
Yeah. I mean, it works out really well for a lot of our clients who are selling. I mean, it works well for real estate, but mostly we see it in people who are not selling assets, not real estate. So like, business, stocks from your job, because those we cannot 1031 exchange. So the O zone is another great way to defer it and have some tax-free growth as well. Oh, the one thing I will share from the One Big Beautiful Bill, I feel like I don't talk about it a lot because it does not apply to a lot of people, but if someone listening is in the right profile, it's super, super impactful. So if you own real estate that you are using for manufacturing business, we can now actually do 100% write-off, 100% depreciation of the whole building. So no cost segregation needed. Yeah. So if I'm a manufacturer, I have a building that I'm buying for $10 million, you just write off the whole building, which is super crazy.
Yeah. See, we need to go buy a manufactured housing company and then write off the whole purchase of the building. So,
it's really interesting you say that because I was just in Maui meeting with a client and, I just kind
know.
of brought this up. Like, it's not applicable to you, but it's just something, that's new and interesting. And he said, yeah, I'm actually thinking of doing manufactured housing like myself. So you never know who's listening, who that applies to.
In Maui. I wonder who that was. I'm curious. No, I'm
Maui.
joking.
I know who thinks like that too. So I love thinking big like that. So
before we get out of here, I want to know how we can get a hold of you, or folks can get a hold of you who are listening, because I got a feeling people are listening in their car or on a run or wherever they are, and they're like, man, I want to talk to Amanda. I want to maybe pick your brain. So what's the best way to get a hold of you?
My company is called Keystone CPA. So you can go to keystonecpa.com, and we have a lot of great free resources. If like real estate professionals, new to you, we have a lot of great information on things like that. If you're looking for daily tax tips, best place to find me is on Instagram. My handle is Amanda Han CPA. And then same handle on my YouTube channel as well.
Awesome. Thank you, Amanda, so much for being on. Thanks for making taxes fun.
Thanks, guys.